Hello traders, welcome back to the Forex gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about one of the most powerful yet often misunderstood tools in the Forex trading arsenal, the candlestick pattern. This pattern has been used for traders in centuries to predict the market movement, but with so many different formations out there, it can be overwhelming to know that which one truly works. So by the end of this video, you will have a clear understanding of the best candlestick pattern that has consistently delivered results, and may importantly, how to incorporate them into your trading strategy to improve your chances of success. So stick around with us until the end of this video to learn how to harness the power of these patterns and take your trading to the next level. We start by understanding what the candlestick patterns are, and they are visual representation of price movement on the financial chart. They provide insight into the market sentiment and potential trend reversals and continuations. These patterns are often formed by combining open, high, lows and close price over a specific period, offering a snapshot of market activities. So let's look at little bit of types of candlestick pattern we know. The candlestick pattern are broadly characterized into two, which are the bullish pattern, which indicates upward movement, often signaling a reversal or a continuation in the uptrend. So examples of this pattern are bullish engulfing. This is an example of a bullish engulfing. This green candle to the upside is a typical example of a bullish engulfing, followed by a hammer pattern. This hammer pattern is a typical example. This particular one is a typical example of a bullish pattern. The two are examples of bullish pattern. Hammer pattern is an example of a bullish pattern. Then we'll talk about the bearish pattern, suggesting a potential downtrend. A potential downtrend movement, and it also signals a signal reversal or continuation of the downtrend. And we are looking at patterns such as the bearish engulfing. This is a bearish engulfing candlestick pattern, and this is the evening star. These are examples of bearish patterns, the evening star pattern and the bearish engulfing pattern. This pattern helps traders to identify shifts in market sentiment and make informed trading decisions based on recognizing potential trend reversals or continuation. However, no pattern guarantees a specific outcome, as they represent tendencies rather than certainty. So if we look at such patterns on the chart, you'll be able to spot one or two of them. Like I can spot our bearish engulfing in this area. I can also spot our hammer in this area. We can spot a bullish engulfing. We can spot an evening star at this area. This is basically what we need to spot and how to spot them on your chart. So let's talk about what the bullish engulfing pattern is about. The bullish engulfing pattern is a two candlestick reversal that typically forms after a downtrend. It consists of small bearish candles before, followed by a large bullish candle. And let's look for a good example to make us not get confused in this setup. Go to the daily, the 4-hour chart to get a better understanding. It is formed during a downtrend, bullish engulfing. At the end of a downtrend, you see a bullish engulfing candle. As you can see, this is a bullish engulfing candle. This is also a bullish engulfing candle. This is a bullish engulfing candle which engulfed the previous candles. It can be a bearish candle or a small candle, but this is a typical example of a bullish engulfing candle. Let's look for more examples for us to understand. At the end of a downtrend or probably a retracement, as we can see, this is a bullish engulfing. It engulfed the previous 1, 2, 3, 4, 5 candles. So this pattern indicates that buyers have gained control over the market, potentially leading to a trend reversal. So this is basically what we're talking about in a bullish engulfing. Steps to trade this bullish engulfing pattern. First of all, you identify the overall trend in the market. And as you can see, the overall trend, you look for a bearish trend, a small bearish candle followed by a large bullish candle. Now in this downtrend, when price got to this downtrend, we can see we saw a small bearish candle, which is a hammer candle, followed by the bullish engulfing candle. This pattern ensures that it forms at the swing low for a strong signal. So to be sure that this pattern is a strong pattern, it forms at the swing low, and as you can see, this is the swing high, this is the swing low in a bearish sentiment market. Now to confirm the setup, you use additional indicators. You can use additional indicators like your moving average to confirm your trend, or you can use market structure or price action. We can also make use of the RSI to confirm the reversal, or use increased volume to indicate if the bullish sentiment is strengthened by this signal. So if I add the volume and look at that area, we can see that there is an increased volume at that area, signaling that yes, there was strong momentum in the market during that time. So we enter our long position when price has broken the high or has engulfed the candle. You can enter when price has broken a previous high using the engulfed pattern, or when price has broken the engulfed pattern. As you can see, this is the engulfed pattern at this area. When price broke through the engulfed pattern, this would have been your best time to enter. You enter on this candle that broke the engulfed pattern. Remember, setting of stop loss is very important. Stop loss should be set below the engulfed candle. Below the engulfed candle should be where you set your stop loss. This is typically how to set your stop loss, and it will help you to limit potential losses while taking this trading setup. Now let's look at the hammer pattern. What are the hammer pattern? And I can see we can spot a hammer pattern in this same example. The hammer pattern is a bullish reversal pattern that forms during a downtrend. It forms during a downtrend, and it consists of a small body at the top of the candle with a long lower wick. A long lower wick with a small body on the top part of the candle. Color doesn't matter in a hammer. It can either be a green candle or can be a red candle. It is not really significant. The color is not significant. You just need to know that it indicates that buying pressure overcame the selling pressure in the market. So this is an example of a hammer. As you can see, this is a hammer candle. This is also a hammer. This is also a hammer candlestick pattern. Now, first of all, to trade the hammer, you have to identify the pattern. You look for a small body with a long lower wick. Let's look for a different example to not complicate our overall identity, because we use this for a bullish engulfing. Let me look for a different example. And I can see here, this is a typical example of the hammer. This is another hammer over here at the end of a bearish trend. As you can see, you first of all look for the pattern. You look for a small body candle with a typical long lower wick, typically occurring after a downtrend. This pattern is more significant if it appears at a level of support, and it appeared at a level of support. If you can mark out this previous swing low here, you can see this is a level of support that the pattern appeared at. This is a level of support. Even if it broke below, it broke back up to the upside, showing that price was still respecting this support area. To confirm your reversal, you have to wait for the next candle to close above or gap above the hammer candlestick pattern. So the next candle is a bullish engulfing that closed above the hammer candle. This confirms our reversal signal. So we enter a long position at the open or at the close of the confirmation candle. You can enter at the close or the open of the next candle after the confirmation candle. That's when you enter your particular trade. You set your stop loss just below the low of the hammer. All stop loss should be placed below the low of the hammer. This is a position where invalidates our trade setup when price gets to that area. Your take profit can be aimed for 1:2 or 1:3, a fixed risk to reward ratio. Now, the next candlestick pattern we are going to talk about is the evening star. The evening star is the next candlestick pattern we are going to talk about. Now, the evening star is a 3 candle bearish reversal pattern that occurs or forms at the top of an uptrend. It forms at the top of an uptrend. This is the 4-hour candlestick pattern. You can see this is a mini uptrend, a trending to the upside, creating series of higher highs, higher lows, higher high, breaking this previous high. So at the top of an uptrend, this is where we see our evening candlestick pattern. It consists of a large bullish candle and a small bodied candle followed by a long bearish candle. It starts by a long bullish candle followed by a small bodied candle, either bullish or bearish candle, a small bodied candle followed by a long bearish candle. This signals potential bearish reversal. This pattern indicates that sellers have gained control over the market, potentially leading to a trend reversal. Now, how do we trade this setup? To trade the evening star, you first identify your pattern, as I've identified my pattern in this area at the top of an uptrend. It has to be at the top of an uptrend. This is a significant uptrend because this is a 4-hour time frame, meaning is a stronger time frame. So this is the top of my uptrend in this area. Then we ensure the bearish candle close below the midway point of the first candle. As we can see, it closed below the midway point, even below the overall candle of the overall first candle. This is a bearish engulfing. As you can see, when you confirm that, you confirm your reversal by verifying the bearish candle close below the midway point. This strengthens your setup. You can also make use of your volume indicator to find out if the momentum was really to the downside in that area. And as we can see, we had the momentum to the downside in this area at the evening star candle. We enter a short position below the low of the third candle. So to enter a short position, you enter it below the low of the third candle. This is where we will enter. Immediately the third candle forms, the next candle that is opening, you put a sell stop below the low of the candle. This is how you enter your trade. Then you set your stop loss above the high of the second candle. Above the high of the second candle should be where you put your stop loss. To put it in a place of invalidation, when price gets to that area, it means this pattern has failed. This is how you invalidate the setup. Then your take profit can be a standard take profit of 1:2 or 1:3, as the case may be. Some additional trading tips: you can always use your volume indication, your volume confirmation. An increased volume during a signal candle indicates a strength in the reversal. This is what it indicates, a strength in the reversal, whether it is the second candle for a hammer or the third candle for the evening star. If it's the second candle for your hammer, candlestick pattern is where you would want to verify this trend reversal. This is where you want to verify the volume confirmation. When you confirm the volume in this area, as you can see in this area, you can confirm the volume was an increased volume. This is basically what we are looking at. Even in this area, you can confirm the volume was an increased volume. So we can also confirm this by support and resistance area. If these particular patterns appear at a support or resistance area, it further strengthens our setup. Like this particular setup, this hammer candlestick and the engulfing, it appeared at a support region. If we can go back and check where we would see our hammer candlestick pattern, we would find out that our evening star happened to form at a resistance area. As we can see, this is a resistance area. We can see that this particular evening star occurred in a resistance area. This is a place where price was finding it difficult to break this area, reacting from this area before price got to this area, formed the pattern and dropped to the downside. So support and resistance further strengthens the effectiveness of this pattern. You can also combine your patterns with little other indicators such as your RSI or your moving average to further confirm this reversal. Alright traders, we have come to the end of this video. If you found this video helpful, do not forget to engage with us in the comments below. We want to hear about your experiences. Don't forget to like, subscribe and turn on your notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching and I will see you in the next video.